Forex is plummeting, down 0.75% this week, as a bearish trend takes hold, driven by rising interest rates, and a critical risk is looming. This could be the catalyst. This is what every serious investor needs to know about Forex right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, the overall market context is one of elevated uncertainty, with the VIX index sitting at 29.9, indicating a high level of volatility. In this environment, the Forex sector is particularly noteworthy, as it has been exhibiting unique dynamics relative to the S&P 500. While the broader market has been experiencing significant fluctuations, the Forex sector, as represented by the UUP sector ETF, has seen a decline of 0.75%, which is relatively modest compared to the overall market. This resilience is a key reason why the Forex sector deserves attention right now, as investors seek to navigate the complex and unpredictable market landscape. As we delve into the world of currencies, it is essential to consider the broader themes and trends that are shaping the sector. Please keep in mind that this educational content is not financial advice, and it is crucial to do your own research before making any investment decisions. Let us start with the technical picture and what the charts are telling us. The Forex sector, as represented by the UUP ETF, has experienced a weekly decline of 0.75%, despite a monthly gain of 2.18%. Notably, the RSI reading of 66 implies a condition of overbought momentum, which can be a bearish signal, suggesting the potential for a pullback or consolidation. This RSI level indicates that the upward trend may be losing some conviction, as the momentum that drove the recent gains appears to be waning. The current trend direction is still upward, but the conviction behind it is weakening, which could lead to a retest of key support levels. Resistance levels are likely to be found at recent highs, and a failure to breach these levels could exacerbate the bearish sentiment. The question now is whether the current move represents a sustainable breakout or an extended overreach, ripe for a correction. This week, we will be watching the technical setup closely, looking for signs of a breakout or a reversal, as the sector navigates this critical juncture. The RSI reading, combined with the recent price action, suggests that a period of consolidation may be ahead, which could provide insight into the sector's next direction. Now let us look at the fundamental catalysts driving this sector. This week, the Forex sector is poised to be influenced by general macro conditions, with the US dollar index, or DXY, serving as a key barometer of sector health. The DXY has been exhibiting elevated volatility, and this trend is likely to continue, given the current market regime of elevated uncertainty, as evidenced by a VIX reading of 29.9. Key currency pairs, such as Euro to US dollar, Pound sterling to US dollar, and US dollar to Japanese yen, will be closely watched, as they often provide insight into the relative strength of their respective currencies. The Australian dollar, as measured by Australian dollar to US dollar, will also be important to monitor, particularly in light of any developments in commodity markets. Economic data releases and earnings reports will be scrutinized for clues on the trajectory of monetary policy and its implications for Forex markets. Regulatory news, while less likely to be a major driver this week, could still have an impact, particularly if it pertains to trade or currency manipulation. The longer-term fundamental thesis for being positioned in this space centers on the ongoing dynamics of global economic growth, inflation, and interest rates, which will continue to influence the relative value of currencies. As we consider the various macro tailwinds and headwinds at play, it is essential to remember that this is educational content and not financial advice. Next, let us talk about the specific risks you need to manage this week. In the Forex sector this week, investors are facing significant risks, primarily stemming from geopolitical tensions, monetary policy uncertainty, and rising volatility, as evidenced by the VIX index at 29.9. These factors can lead to sudden and sharp price movements, making position sizing crucial to manage potential losses. Given the current volatility environment, it is essential to adopt a disciplined framework for managing downside exposure, which includes setting clear stop-loss levels and maintaining a balanced portfolio. Unexpected headwinds, such as surprise interest rate changes or unforeseen economic data releases, can also impact Forex markets. To mitigate these risks, investors should prioritize risk management, focusing on careful position sizing and maintaining a long-term perspective. By doing so, they can navigate the current uncertain landscape. And now for the strategic outlook. Where does Forex stand heading into next week? This week, our strategic positioning recommendation for Forex is cautious, due to increased volatility. A key theme to track is the impact of monetary policy on major currencies. Remember, this is educational content and not financial advice. If you found value in our analysis, please like, subscribe to Financial Market Oracle, and comment your Forex watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.